Professional ethics then. So what we're going to look at today is the basic knowledge that you need in order to tackle these professional ethics questions, the 5 fundamental principles of professional ethics, the 5 threats to those fundamental principles, and 5 steps that you can take to solve ethical dilemmas in the exam. Primarily, we're going to be talking about the 25 mark section C from paper 1 questions. So you should have a knowledge of the accounting concepts. I'm not going to go through these in any detail. Safe to say that the first 3 here are the gateway concepts that apply to everything. So they could well come up in some form or other. And then these 3, consistency, prudence, and accruals, are most likely to be the ones that are going to have an impact when it comes to professional ethics. So if you don't know the accounting concepts, you need to go back to the year 1 material and look at those. Accounting regulations as well, your studies of limited company accounts. So in year 1, smaller limited companies, and in year 2, the PLCs, should give you an awareness of the Companies Act 2006, the FRS 102, so financial reporting standard that's used by smaller limited companies, the International Accounting Standards and the IFRSs. You don't need any detailed knowledge of those, but an awareness of IAS 1, presentation of financial statements, and IAS 7, which relates primarily to the layout of your statement of cash flows. You should know about the role of the professional accounting body. So we've got the CCAB, which is an umbrella organisation for the chartered bodies that are concerned with financial accounting and therefore external audit. So that's your AQA, CIPFA, ICAEW, CAI, and the ICAS. There's also the Chartered Institute of Management Accountants, which aren't concerned with external audit because they have a focus on management accounting. But all of those will have their own ethical codes of conduct to give you guidance based on the 5 fundamental principles and how to identify threats to those principles. So I'm not going through any of that in detail. You can look that up elsewhere. The other thing you need to know about is directors and auditors' responsibilities. Remember, the directors are the ones that are responsible for preparing the financial statements. It's the auditors that express an opinion on those financial statements as to whether they show a true and fair view. The directors and the auditors are both appointed by the shareholders, and you may also have internal auditors, so those are part of the finance team working within the company, which would have their own kind of safeguards in place to help make sure that fraud doesn't occur and things are accounted for properly. Okay, so on to the 5 fundamental principles then. So these apply equally to accountants that are working within the business, directors that are running the business, and auditors who are responsible for expressing that opinion as to whether the accounts show a true and fair view. So there are 5 that we need to learn. The first one is integrity. These are in no particular order. Objectivity is another one. Professional competence and due care, confidentiality, and professional behaviour. Now you need to learn these 5, you need to know what they're called, you need to know what they mean, and you need to be able to identify potential threats to these fundamental principles. So I'm going to suggest maybe use a mnemonic. So I've got some ideas here, IOPCP, so that's the order I've listed them in there. So in Oxford, penguins can party, or we could go PICOP, people in cars often park. However you want to try and remember it, if you find mnemonics helpful, then that might be a good thing to do. But those are the 5 that you need to learn. So we're going to go through each of them one by one, bearing in mind that these will apply in different circumstances to accountants, directors of the company, and auditors. So the first one, integrity. So integrity is about being straightforward and honest in all your professional and business relationships. So not lying or not withholding information that could lead to people making the wrong decision. So you mustn't be associated with any reports, returns, or communications or other info that contain false or misleading statements. So contain statements or information furnished recklessly, I can hardly say it. Anything that omits or obscures information so as to be misleading. It's often about what you don't say rather than what you do. So any issues with any of that, the action that you're required to take, whether you're an accountant or director, is to disassociate from that information. Okay. The second one, objectivity. So this is about not allowing bias, conflict of interest, or undue influence of others to override professional or business judgment. So we need to do things for the right reasons, not the wrong reasons. We need to maintain our objectivity as accountants, as auditors, and as directors. So we should avoid situations and relationships that compromise objectivity. So it wouldn't be appropriate for someone to audit a company's accounts if they are married to the managing director of that company. That's just too close. So don't carry out professional services if you're an accountant or an auditor if a relationship or the circumstances mean that you can no longer remain objective. So there are lots of examples where that might apply. Competence, so professional competence and due care. It's up to you to maintain professional knowledge and skills at a level to ensure competence. So keep up with current developments in practice, in legislation, and in techniques. To undertake CPD, continuing professional development, so that's like training when you're working as an accountant, and ensure that professional staff receive training and supervision. So if you're responsible for a team, if you're the finance director, it's down to you to make sure that those staff are properly updated. Ensure that you've got sufficient time as well to carry out work carefully, thoroughly, and on a timely basis. So if we rush, we're far more likely to make mistakes, not come up with the right answer. So don't undertake work for which you're not properly trained or qualified, and do not rush to meet unrealistic deadlines. So on the napkin there on the picture, it shows you some things: experience, knowledge, ability, attitude, and behaviour. That would all lead to professional competence. That would apply whether you're an accountant, an auditor, but also directors of the company have a duty of care towards the shareholders of that company and the public at large. So those things would apply to them as well. Breach of confidentiality, pretty much common sense with this one. Confidentiality: do not disclose information to third parties unless proper authorization has been given, or if there's a legal or professional duty to disclose that information. Don't use information for personal advantage or pass to third parties. So this would be things like insider share dealings, that sort of thing. So unless you've got authorization, you can only disclose confidential information when it's required by law. So HM Revenue and Customs, investigations, money laundering, anti-terrorism, National Crime Agency, that kind of thing. So the last one of the 5 is about professional behaviour. So accountants' behaviour, and auditors and directors, must comply with relevant laws and regulations and avoid bringing the profession into disrepute. So you mustn't make exaggerated claims for your services, your qualifications, your experience, and don't make disparaging references or unsubstantiated comparisons to the work of others. So you shouldn't be defaming other people, making derogatory comments. That's not good, not a professional way to carry on. So let's check your learning then at this point. Can you remember the 5 fundamental principles? You might want to pause the video, use your mnemonic. So did you go for, in Oxford, what was it, penguins can party, or people in cars often park, whichever one it is. Can you remember the 5? So pause the video, jot them down. Can you remember what they mean? If not, perhaps go back and review the previous slides. But you should have got IOPCP, if we do it in that order: integrity, the O is objectivity, the first P, professional competence and due care, the C is confidentiality, and the P, the last P, is professional behaviour. Okay, so those are the 5 fundamental principles that we need to adhere to. And we're now going to look at 5 potential threats to those fundamental principles, so things that might happen to compromise these principles, to make us act in a way that's not ethical. Okay, so the threat then, just to define that, it's a person or a thing likely to cause damage or danger. So there are 5 threats to those fundamental principles. 1 is self-interest, so that's acting in your own best interest rather than the best interest of the client that you're auditing, or the company that you're running as a director. Self-review, so that's about checking your own work and largely coming to the same conclusions. You should be thinking about segregation of duty. Familiarity, so this is relationships that might compromise those fundamental principles. Intimidation, so this could be either something that you imagine or something that really is happening. And advocacy. Okay, so these are the potential threats to the fundamental principles. Okay, so let's look at those potential threats in a little more detail. Self-interest, this is where a financial or other interest inappropriately influences the accountant's behaviour. So you've been asked to make an adjustment to the accounts, and perhaps one of the directors has a villa in Spain and they're offering you the chance to use that villa if you make the adjustment. Okay, so self-interest there would be the use of the villa, so that might lead you to make a decision that's not wholly appropriate. Self-review, this is where the accountant has to re-evaluate a judgment or some data that she or he has previously made or produced. So generally, you're going to come to the same conclusion as you did the first time. So really, we need to look at somebody else reviewing work rather than you looking over it. So familiarity is where close personal relationships can make the accountant too sympathetic to the interests of others, and often self-interest plays a part there, so it goes alongside familiarity. Intimidation, so this could be real or perceived threats, so it's where the accountant is deterred from acting objectively due to real or perceived threats. So a real threat, you've been told that, if you don't do as asked, you're going to lose your job. Or a perceived threat, you might just kind of think, well, actually, if I don't do this, my life's going to be hell, or I'm not going to be looked at for promotion, that kind of thing. And then advocacy, this is where the accountant promotes a position or an opinion of a client to the point that his or her objectivity may be compromised in the future or actually at the moment. So self-interest, again, could play a part there. So you're trying to encourage, the company to do something that you think might increase the price of a company that you've got shares in, for example. So we need to watch out for that, trying to remain neutral, trying to remain objective. So when we've got these ethical dilemmas, I think often we can look at the theory, but the easiest way to get a handle on this is to look at some potential ethical dilemmas. So we've got a couple here to look at, and 5 steps that we can take to help solve them. So the first one, we need to establish what are the facts. So sometimes it will tell you that something is rumoured to be happening, or it's been suggested, or somebody overheard something, but what are the actual facts? Let's get those straight before we start. Let's think about which ethical principles are potentially going to be compromised. Think of your 5. Is it integrity? Is it objectivity? Professional competence and due care? Is it confidentiality? Or is it professional behaviour? And then what are the threats to those ethical principles? Is it something to do with self-interest, self-review, familiarity, intimidation, advocacy? And remember, it could be a combination. It could be a combination of ethical principles that are compromised, and it could be more than one threat to those principles. Are there any internal procedures or safeguards in place to reduce or mitigate the risks? So is there an internal procedure, so internal audit, for example, that would help to pick up any problems at a later date? And can you think of any alternative courses of action that could be taken? So is there a better way around this, to what you're being asked to do? So let's look at the first dilemma. And your manager has asked you to claim expenses under a different cost centre than is normal on the grounds that the budget is underspent, whereas the budget for the correct cost centre is already overspent. So if you allocated the cost correctly, they would cause a further overspend. You're being asked to put the expenditure against another budget. Should you be doing that? So what would you do? What would you think about? Is it the right thing to do? Let's think about the ethical principles that might be compromised if we do that. Let's think about the facts first of all. So we're not being asked to claim anything fraudulently because these expenses are legitimate. We're just being asked to put them into a different cost centre. So you're not going to be benefiting from this financially. You haven't been offered a bribe or anything to do this. The issue is whether the budget information and your variance analysis, when you do expenditure variances on those budgets, will it be reliable if managers have been manipulating the use of budget code? So the idea is to identify areas where overspends or underspends have occurred and take remedial action. But if you've manipulated the costs going into those budgets, that information will be skewed. So it says the incorrect allocation of the expense could result in senior management being deliberately misled. Now, we're not told about the amount of the expense here, so we don't know whether it would be material or not. You might think that you've got no choice because your manager is asking you to do this, but should you be taking more responsibility for your actions, and should you be seeking more information from your manager about this? Okay, so the ethical issues involved, obviously it's integrity. You know in your heart of hearts that you're doing something wrong here. So clearly integrity is going to be the main fundamental principle that's being breached, but also your objectivity. You're not necessarily doing things here for the right reason, or your manager certainly isn't. And what are the threats? So in addition to your integrity and objectivity, there's a potential intimidation threat from your manager. Just the fact that they are your manager is intimidating enough. So you want to keep your job and see your career progress. So this intimidation threat could be linked to one of self-interest. If you don't do as your manager asks, you might be passed up for promotion or further training. So even if you don't consider your manager to be intimidating, you might find it difficult to challenge his or her request due to the fact that they are a manager, or due to the closeness of your working relationship. There could be a familiarity threat there. Since you're not being asked to act dishonestly for personal gain. I mean, it is quite dishonest putting this expenditure to the wrong cost centre, but you might decide the threat to your integrity isn't particularly significant, but you're thinking about the consequences and not the risk. You're also ignoring the possible consequences that senior management may be deliberately misled as a result of your actions. So the risk of this happening is quite significant unless appropriate safeguards are put in place. So do you know that somebody else reviews the budgets before they go further up the line? That might be a suitable safeguard to help mitigate any problems further down the lines. So have we got any internal procedures? What kind of safeguards would ensure that budgetary codes aren't misused or manipulated? So you might be aware that the analysis of the expense claim will be drawn to the attention of management by way of procedures that already exist. So an additional safeguard to allow the proposed action to go ahead would be to discuss the situation with your manager and seek assurances from him or her that the treatment of the expense claim will be disclosed to the users of the information, so that somebody else will be told about it. You might also discuss the situation if you're really uncomfortable about it, discuss it with an independent person. You've obviously got to maintain confidentiality about the client or the company. So you could talk to your professional body's technical advisory service. Most of the professional bodies have a telephone helpline. So if you're a member of the Association of Accounting Technicians or the Institute of Chartered Accountant in England and Wales, or the Chartered Institute of Management Accountants, they will have a helpline for just such a dilemma. Okay, can we think of an alternative course of action? Is there a way that we can deal with this that will avoid upsetting the manager? We've got a nice picture of a cute cat there looking into a mirror, but there is this thing called the mirror test. Can you look at yourself in the mirror after you've taken a particular course of action and be happy with what you see? So ask yourself if you're satisfied with the safeguards that exist and or will be put in place. Are you truly satisfied that the risk of breaching the principle of integrity is or can be made insignificant? Whether you take steps to ensure that management are made aware of the expense coding or you refuse to carry out the request of your manager, you should ask yourself whether you would pass the mirror test. So are you proud of who you see in the mirror after following your actions? You may decide to obey your manager's request and use an incorrect budget code because you want to protect the budget holder's position and because you've received assurances that the proposed action won't result in senior management being misled. But on the other hand, you may feel that as a professional accountant, it's your duty to report expenses as they are because you aren't comfortable that the proposed course of action wouldn't mislead senior management. So which decision feels right for you? Are you able to look at yourself in the mirror comfortably? Now, something like this could occur in real life, but we're really preparing ourselves for an exam scenario. So remember, with those 25-mark questions, it's about getting balance. So it's about saying, well, it might be fairly insignificant because, or actually this could be a very serious breach because, and then overall coming out with a judgment. And often there are a lot of grey areas. Some of the questions you'll be posed with, the dilemmas, will be very cut and dried. It'll be very obvious that this is fraud that's occurring. It's really not good. Whereas other things like this one, it's a little bit more of a grey area. We're not told the magnitude here, so we'd be identifying limitations. How much are we talking about? Is it a significant part of the budget, or is it fairly insignificant? Is it going to matter in the long term? Okay, let's look at another one then, number 2. So this is about audit. So obviously when we prepare our financial statements at the end of the year as a company, we get the external auditors in and they're coming to check that everything looks okay. They can't possibly check every single transaction, so they'll check a sample of transactions and they'll report on whether or not the accounts show a true and fair view. And at the end of the day, everybody wants a clean bill of health. They want an unqualified audit report. If it's qualified, it means that a problem has been discovered, and that could, set alarm bells ringing amongst employees of the company, shareholders of the company, the general public at large. So with this second ethical case study then, we've got a case of non-disclosure to auditors. So this is about not telling the auditors something. So let's read on. It says that you're employed as an accounting systems manager in a company that manufactures heavy plant. You and the financial controller both report to the finance director. During your work, you overhear the financial controller saying that he has not disclosed certain things to the external auditors. These include the fact that the recent acquisition has resulted, I think this is the recent acquisition of machinery, has resulted in a large piece of machinery becoming redundant and of very little value. You are unsure whether to believe this, but you are concerned that the culture within the finance department appears to be one of antagonism. That's deliberately winding up. So antagonism towards the external auditors, who are unreasonably, in your opinion, seen as adversaries of the company. So what's that saying is, in plain English, that the auditors are seen as the enemy, if you like, and people are going out of their way to be unhelpful. And that's not an uncommon stance. In addition to all of this, you heard that a bribe was paid to an overseas company to secure a sales contract. You feel uneasy about this situation, and you're concerned that the close relationship between the financial controller and the finance director may prevent you from exploring the accuracy of the information. So quite a lot going on there with this company. So let's think of first of all, what are the facts? So is it fact or is it opinion? Is it hearsay? Most of this does seem to be hearsay. Can the facts be corroborated? Can we validate those facts by looking at documentation or talking to relevant parties? So what can we find out about this? If we are of the opinion that something really bad has taken place or is happening, is there an internal process for whistleblowing if those facts are proved? What channels of communication, so meetings, email, phone, etc., are there between the company and the external auditors, the company's audit committee, or an ethics officer within the company? So who can you tell about this? Who can you raise the alarm with? Because obviously the people above you, the person that works with you and the person above, are both potentially involved in this. So steps 2 and 3, we need to think about the ethical issues and which of our principles are being threatened. So our integrity, generally most of these professional ethics questions are going to involve integrity at some point. So can we overlook the financial controller's comments? Do we just ignore those? Do we ignore the culture within the department and the alleged bribe and still demonstrate our own integrity? So are we demonstrating integrity by just standing by and letting it happen? Is there an issue with confidentiality? So is there any basis on which you may or you must make disclosures to the external auditors or anyone else? So is it anything to do with money laundering? Probably not. Professional behaviour. How should you proceed in order to comply with the relevant laws and regulations, and so as not to bring the profession or yourself into disrepute? So step 4, we need to think about any internal procedures that exist to mitigate the circumstances. We've got a picture here of somebody blowing the whistle and lots of people trying to put knives into his back. So is there an internal process for whistleblowing if the facts are proved? We might be told about that in the question, or we might just have to raise that as a potential limitation. And then think about the channels of communication that there are between the company and the external auditors. Who's responsible for those communications? Is there an open communication between the two? Possible course of action. So we've got to check relevant facts, perform research into accounting standards, applicable laws, regulations, anything that may support you in alleviating your concerns. Okay. In particular, are there any anti-bribery policies and procedures in place? There certainly should be in a company. You could discuss the matter with the finance director, regardless of the close relationship he has with the financial controller. So there's a potential familiarity threat there. If his response is unsatisfactory, the next step would be to take the matter to the board of directors, so maybe the finance director. It would be prudent to involve them in this if possible. Okay. If you've got suspicions or evidence of criminal activity, so the bribe, if you've actually found evidence of that, you might be obliged to report it. Check with your professional accountancy body or take legal advice, because this is potentially very serious and could be quite career limiting if you get it wrong. Make sure you document all of the steps you've taken in case your ethical judgment is challenged in the future. So you need to be able to say why you did all of this. Okay, so let's have a check of your learning then. Can you still remember the 5 threats to the fundamental principles? So self-interest, self-review, familiarity, intimidation, and advocacy. If you can't remember them, go back and learn them, learn how they could impact on the fundamental principles of professional ethics. So hopefully that's given you an idea of the main bits that you need to learn and how to apply those in different scenarios. I'm going to record a separate video going through a past exam question, Jaheen, which came from the 2020 paper one, which was all about professional ethics. But thanks very much for watching. If you enjoyed the video, don't forget to like and subscribe, and I'll see you again soon. Thanks for watching.